As initially theorized and put into practice by Benjamin Graham and eventually mastered by investors like Warren Buffett and Charlie Munger, buying businesses for below their intrinsic value can offer investors a unique combination of protection from downside, a margin of safety against losing money should their analysis of a particular stock or a particular private business be incorrect, and it can also give investors the opportunity for greater upside as their investment bounces back to a market price closer to its underlying intrinsic value. And methods for trying to estimate intrinsic value, like using simple price to earnings multiples, or even looking at discounted cash flow models and trying to project forward how much cash a business might throw off into the future, are reasonably familiar processes to a lot of investors. Yet, when it comes to analyzing the intrinsic value of a financial company like a bank, that is certainly an area where far fewer investors are comfortable in their assessment of intrinsic value. Yet we know that many value investors, like Warren Buffett in particular, have very long track records of investing successfully in bank companies. So how exactly you might go about estimating the intrinsic value of a bank in a relatively simple manner is really what I want to cover in this video. Because estimating the intrinsic value of a bank stock or another type of financial company is a different beast to analyzing the intrinsic value of a typical company. Banks tend to have a whole lot more leverage than most companies, and it tends to be more of an asset-based approach as opposed to an earnings-based approach or a free cash flow type approach, which you might use for most companies. Although over the long term, earnings are really what will drive your return as an investor in a bank stock, earnings can be very volatile, which makes metrics like a PE ratio a little less meaningful for most bank companies. The earnings can swing around very wildly. I'll put up Bank of America here, for example, and show you how their net income has fluctuated year to year. And using typical discounted cash flow models can also be quite problematic. Again, because these earnings can swing around quite wildly, there is a degree of normalizing some of those earnings that's required by the person that's analyzing a bank and trying to understand its intrinsic value. Some investors may look to use the cousin of the discounted cash flow, a dividend discount model, which might look at the future dividend payments you're likely to get out of a bank and discounting those cash flows back to today. But again, that might not necessarily be all that representative of the full value of the bank, particularly if they are retaining a lot of their earnings in order to grow the business. In many ways, the analysis is going to be much more similar to how you might look at a real estate investment. If you are going to buy a handful of real estate properties off a local real estate investor who was looking to sell up, you would try and really have more of a balance sheet type focus, where you would look at the value of the assets, you would look at the typical return those assets can generate, and you might also look to incorporate the amount of leverage that you expect to use as you hold those real estate investments. And it's of course difficult for a real estate business to grow without taking on more liabilities in order to buy more assets. So maybe taking on more debt in order to buy more real estate properties, which of course will flow through to greater rental incomes and earnings off those properties. And the same theme holds true for banks. It's very difficult for banks to grow unless they take on more liabilities through deposits that come into the bank, and they then take those deposits and lend them out and make loans which become an asset for the bank. So calculating intrinsic value and expected return is going to be very, very balance sheet focused. And in this video, I want to use an example company, Hingham Institution for Savings, which I've mentioned in a couple of previous videos. This is purely just for example purposes. Don't take this as a stock tip or my actual expected return for Hingham's. I'm just trying to work through some examples. If you're actually interested in the company, please do your own work on digging into this one. But let's walk through some example numbers of how I would personally calculate an expected return from a bank like Hingham. So in order to calculate an expected return from Hingham, I'm really going to need three different pieces of information. Firstly, I want to know the return on assets. Secondly, I want to understand how much leverage Hingham are currently using and what I expect they might use in future. And thirdly, I want to understand the current price, and more specifically, what multiple am I paying of book value or the multiple of equity kind of in the business. It's one thing to understand the return on equity that the business is generating, but if I am paying a premium price, if I'm paying greater than the book value to get into that bank, they're going to have to earn on my purchase price rather than a simple return on equity. My return as an investor will be lower if I pay a premium to book value, and my return will be higher than the return on equity if I pay a discount to book value. So in the case of Hingham, with that first ingredient of return on assets, the 10-year average return on assets is 1.3%. Now, that return on assets has actually grown for Hingham over time. In the past few years, it has been 1.6%, 1.9%, and 2.1%. So it has grown over the past few years. And this is really the bit where you'd want to do the most amount of digging into the specific bank that you're looking at to try and understand what a normalized sort of return on assets you think might be moving forward for the bank. Now, I'm going to use, say, 1.5 as a normalized return on assets for Hingham. That may be conservative. It potentially could be much higher. Again, digging into this specific bank, I've picked up that things like their efficiency ratio have trended down over time. The bank is becoming lower cost and more efficient in their operations over time, which are helping to drive up that return on assets. But just for argument's sake, let's say that I think the normalized return on assets moving forward is going to be about 1.5%. Next, I want to look at the amount of leverage being used in the business. Currently, Hingham has assets to equity of about 10 to 1, or if you want to invert that, equity as a percentage of assets of about 10%. That is actually less leverage than they've had historically. If I put up a chart here, you will see that their equity as a percentage of assets has actually gone up over time, which means they have steadily deleveraged from being as leveraged as about 14 to 1 in terms of assets to equity back in 2010, down to where they're only about 10 to 1 now. And that trend of deleveraging seems to be kind of continuing year after year. So again, this will be a bit of a judgment call for you as an investor, but I'm going to assume that a normalized amount of leverage for Hingham moving forward is that they continue to deleverage, and we're looking at about maybe 8 to 1 assets to equity. And the final piece of the puzzle, as of making some notes for this video last night, Hingham was trading at a price to book of 1.62. So if we run through the numbers and use those assumptions to calculate an expected return for Hingham, I have a 1.5% return on assets, multiply that by my 8 to 1 leverage, that gives me about a 12% return on equity, just 1.5 times 8. And I can divide that by my price to book of 1.62 because I'm paying a premium to that equity or that book value, which gives me an expected return of 7.5%. So is 7.4% the return that we should expect as investors when putting our money into this particular bank with the assumptions we've just laid out? Well, the answer to that is a resounding maybe, and in the case of Hingham specifically, it's actually probably a no, and that's because there's basically two other factors that we still haven't really considered yet that can have quite a substantial impact on our long-term return as investors in banks. And if this sounds like it's starting to get really complicated, don't worry, I've actually created a pretty simple spreadsheet calculator, so if you want to download that template, I'll just put a Dropbox link down in the description below. But essentially the two factors that we really haven't considered yet are, one, the retained earnings, and secondly, any change in the book value multiple that might happen in the market after purchasing into a bank like Hingham. Now, when it comes to retained earnings, let's use basically two extreme examples. Now, firstly, let's take a bank that retains none of their earnings and they pay it all out as a dividend, or maybe they use it for share repurchases. Let's just assume they pay it all out as a massive dividend for this example. Our return would actually be pretty much exactly what we calculated earlier with that 7.4%. That would be sort of the normalized earnings yield we could get out of the bank, and that would be about the dividend yield we can get out of the bank if they paid it all out to shareholders. But where things can get much more interesting is actually in a situation where the bank doesn't pay a dividend, or at least they pay a small proportion of their earnings out as a dividend. So let's take another extreme example and say that this particular bank actually doesn't pay out any dividends to shareholders. They retain it all and they can continue to reinvest that capital and grow with the same return on assets, the same amount of leverage, and let's just assume for argument's sake that there's no change in the price to book value value multiple in the market either. Well, if we take the numbers that I used for Hingham earlier in this video, 1.5% return on assets and a leverage of assets to equity of 8 to 1, then we would generate a 12% return on equity with that retained earnings. If all of that earnings is retained and the book value is compounding at 12% a year and there's no change in the multiple to book value that investors are paying in the stock market, then our return is going to equal 12%. And if we continue to use Hingham as an example, Hingham actually pays out a small amount of their earnings each year as a dividend. They typically pay a combination of a regular dividend and a special dividend. If I look through their 2021 annual report, their earnings were about $31.50 per share. They paid out dividends of $2.83, which gives us a payout ratio of about 9%. So for that reason, since most of the earnings are retained, we're going to get pretty close to that full 12% return. And again, the calculator that you're seeing on the screen here will be linked down in the description below if you want to check that out. And finally, the last factor that we still haven't considered is a change in book value multiple that the market puts on this particular bank. Just like a PE ratio for a company, if the underlying company's earnings does not change, but the PE ratio doubles, then the market price for that particular stock will double. And it's exactly the same with banks. If the underlying book value doesn't change, but the price to book value goes up or down, that can have a very significant impact on our return. And that is particularly important in the short to medium term, say over 1 to 3 to 5 years. Over 10 or 20 years, your return is probably going to tend towards the calculations that we've talked through earlier, because book value multiples for banks don't typically go from 1 to 100 or anything. They might kind of float around in a range of maybe a little below 1 to maybe getting up close to 2 as an example. So again, let's continue to use Hingham as an example, and let's say that we had phenomenal timing and we were able to purchase into Hingham at basically a really low point of valuation in the market. Now, if we look through the past couple of years, the COVID low in 2020 in terms of a price to book multiple for Hingham was about 1.1. Like I mentioned earlier, it's currently trading about 1.6 or so. If it got down to 1.1 and we were able to purchase it there and it returned to its sort of 5-year average price to book, which is actually more like 2, then we have a double just from the price to book multiple change. And if we assume that that multiple change happens over, say, a 5-year period, this is what the updated return numbers would look like for Hingham. We still have a significant amount of our return coming from the book value growth, but we now have about 12.7% per year return coming from the change in book value. And of course, that can't go on forever. You can't just compound to, infinite multiples of book value, but can have a significant impact over the medium term. We still have about a 1% dividend yield, and that gives us a total compounded annual growth rate over, in this case, the 5-year period, because that's the period of multiple expansion we're looking at, of 24.6%. So that is how I would get started calculating the expected return and intrinsic value for a bank stock. I hope you enjoyed the video. If you did, please hit like and also subscribe to the channel if you are new here. Definitely let me know your comments and your thoughts on this video down in the comment section below. I'll try to get back to as many people down there as I can. But that's it from me for this one, and I'll see you in the next video. Cheers.